Hello, everyone. Today, we're going to talk about the 4 cash flow risk construction business owner make and how to avoid them. So if you are a construction business owner, this is for you. Tell me if this sounds familiar. You will win jobs, your book will show profit, but the cash isn't there. That is one of biggest struggles I see, and actually come down to the hidden cash flow risk. Today, we are covering 4 cash flow risks construction business owner make and how to avoid them. Here is what you will walk away with. How retainage tie up your money, why billing versus vendor term create cash cost, the impact of job costing, and how change order and overrun it margin. All right, so let's jump in. Let me share my screen. Hope everyone can see my screen. Okay, so before we start, I'm gonna tell you who we are. I'm Nikki Motin. I'm a EA and CPA. So I'm a founder of Andorra Consulting, a firm specialized in tax strategy and cash flow management. So we work primarily with construction business, healthcare provider, nonprofit company, logistic company, and other. And we show businesses owners how to put more money in their pocket, keep cash flowing, and finally feel in control of their finance. And we start with smart start strategy. Hope I'm sharing my screen. Okay. I hope that I'm sharing. Yes. Okay, I'm sorry about that. Okay. So like I was saying, I'm Nikki Motin. I'm a CPA and an EA. I'm a founder of Andorra Consulting, a firm specialized in tax strategy. So before we move in, I'm gonna share some fact with you. So do you know that 61% of small business fail to manage cash flow effectively? And that on those, 82% say that the problem is not a lack of customer or profitability. It's simple poor cash flow management. 70% of construction business have experienced delayed payment because of slow pay. That is huge drag on cash flow. And this is exactly why today's session is so important. So like I said in my introduction, we're gonna talk about cash flow. We're gonna talk about 4 cash flow risk construction business owner make. So the first one I'm gonna talk about is the retainage. So the retainage is 5 to 10% of your project value, and this is held by the project owner. So the red flag that you will have on your retainage is if your retainage balance is over 80% of your trailing 3-month revenue. So if your retainage is 80%, that is the red flag. You want to make sure that you look into your retainage, look and see what is going on. In the average day of your retainage in more than 120 days, that is a red flag as well. So your retainage should not be your retainage outstanding should not be more than 20 days. And also another red flag is that if you are not separating your retainage from your receivable GL, that is the problem. How are you going to know which one is the retainage and which one is the receivable? So it's good to track them, to separate them. So those are the 3 risks that we have, that we identify. If you see yourself under these 3 bullet points, then you want to look into it. So what we do is what? This is our strategy. First, we will look in your contract, the contract that you have regarding the retainage. So we want you to request a milestone release at 50% plus substantial completion. So you want to make sure that at the milestone you have a release of 50%. And also, what is more important is that you have to gap your retainage percentage at 5%. So when you gap your retainage at 5%, it's a big win. And make sure that you include in your contract that this retainage, this should be reduced by 2% after 50% completion of the project. So if you gap your retainage at 5%, that is a big win. And then at the 50% completion of your project, you will request a release of 2% of your retainage, which is a good thing for your cash flow. And then for those project owner that do not want to go under 10% of the retainage, you want to make sure that you include on that contract so that you will request a percentage of the a percentage release of the retainage at the expectation date. So when there's an expectation, when there's an inspection of the project, you want to make sure that at that day you receive partial payment, partial release of your retainage. This is only if your project owner do not want to go below 10%. After we dig into the contract, we want to make sure that your operation on the retainage is good. We want to also make sure that you have these listed points that you are seeing on the screen included in your operation style. So what is those? You have to track your retainage in separate account. Track your retainage in separate account. Don't lump your retainage with your receivable. That is the mistake. It's a red flag. You want to make sure you track them separately. Also, when we bill your 13 weeks cash flow forecast, we count retainage as a $0. We don't include it on that forecast until the retainage is released. Otherwise, that will be counted as a $0 amount on your 13-week forecast. And then Another bigger point here is your reserve, your retainage reserve bank account. So the money that you have on your reserve bank account should match your balance on your retainage balance, because that helps you to face the cash flow crisis. Uh, so if you are facing a cash flow crisis, you have that retainage reserve that you can use it. Okay, and then once we make sure that these 3 bullet point is set up on your operation. We also want to look at the collection. Yes, you have the contract. The contract is fixed, and then we have the operation. We want to make sure that we have all those bullet points on the operation. Once everything is done, we want to make sure that you have a good collection, policy set up in place. What is one we here we have listed 2 of them. So the first one, you want to make sure that on your project close list, you add a retainage release on it. So once you are doing the punch list for the close out, you want to make sure that your retainer release is attached, because when you are closing out when you are doing the punch list close out, that means your project is completed. So you want to make sure that the retainer should also follow that punch list as well. On your KPI should show your retained percentage of the AR. Very important. That help you to take a good decision. It should be, and so you should have your retainage percentage of the AR and on your KPI, and also the outstanding retainage date. The outstanding retainage date calculation should be there. You want to see everything on your KPI. Very important. Those are the key metrics for a decision regarding retainage. And I have an example here for you. So we have a job that bill $600K, and then we have 10% retainage. What does that mean? That means that we have 60K tied up, and with the margin, with 15% net margin, that is the same cash as a 400K in future sale at 15% growth, at 50% growth you are waiting on. This means that the 60K stock in retainage is financially equivalent to doing 400 more in future sale at 15% net margin. So what is the point here? The point here is that your retainage is not just a delay revenue. It's a cash profit that you already earned and cannot accept it. So that no asset profit take months of future work to replace if you are not manage the retainer carefully. So you don't get that 60K that is like 400K in future sale. So it's very big, right? You don't want to miss it. So that is why it's good to have a better track on the retainage, a better collection policy in place for that retainage. Like I listed, you want to make sure your contract is strategic for that retainage. Your contract on the retainage should be strategic. Your operation on the retainage should be strategic. Your collection on the retainage should be strategic. So everything here should be strategic. So you want to make sure that you implement this. And then the second risk that we're going to talk about today is the poor job costing. Okay, Project costing. What does that mean? So you have job, you don't know how much that job is really make. So on your paper, it said that, yeah, it's profitable. But what about the hidden cost? Do you count the hidden cost on that job costing? I'm talking here about labor, about material, about overhead costs. Do you count those? If not, that is the problem. That is the problem that you don't know which job is making more profit and which one is draining money, right? You don't know, and that can cost you more on taxes. So you should be careful on this. It's very important to make sure that those hidden costs is included on your P&L for the job costing. So what do? We will set up a good job costing for you. And we record every cost. We record labor, we record material, we record equipment, we record overhead costs. So we record those because we want to know which one belong to which job. It's very important so we can allocate it correctly. And then the weekly time. So weekly time should be, we have to capture weekly time from the field. So if the crew is working on this particular job, you want to make sure that you catch up the time that is working on, so you can charge to the correct job. And then the change order. This is something that is surprising. So you want to make sure that you also have a separate code for the change order. Separate code should be done for that. We don't want to mix it with the normal cost of the project. So what we do when we set this up, all this the job costing and all that bullet point you are seeing on for the setup for the job, we also want to make sure that we do the analysis for the job. For example, you have to make sure that you have a weekly job costing report. So that will help you to visualize your actual versus your budget and the completion of the job. This is important. For this week, how much was the budget for this week at this stage of the job? Is it match? Is what actually occur match the budget? If yes, good. If no, why? Those are the questions that we want to ask. But you can only ask this question if you are visualizing, if you have it, if you implement this. So that will tell you what is going on. And then the monthly working process schedule. So the monthly working process schedule will tell you what for overbill and underbill, and the cost of completion. Also the projection of the margin. The working process schedule, like I said, tell you what is over and under bill, because that is what is helping you to see how much you're going to bill for, where are you at, how much you are going to bill at this stage of the project. So it's very important to have this schedule with you. And there also something that is very important. So you should not approve suppliers' invoices without a job code or a stage of completion of the project. So this shows that you keep a better track on your job. So you have your job, and you know what you have all this cost that is listed. For each cost has a stage, right? So if you are 80%, if you are 60% of the completion of the project, you are saying that, okay, I'm going to buy an equipment, and you have that equipment here that they're showing you that equipment, say, okay, this equipment is for job A, right? It's for job A, and you are seeing, okay, this equipment happened, this $200 equipment that we are buying was supposed to be bought at this stage of the project. So is that correct? Yes. So you have the completion, your completion percentage there, and you have the job code that make more easier for you to track them. So you want to make sure that the supervisor that approve those invoices, or you, if it's you, business owner, approving those invoices, you want to make sure that it had, so it had the job code, and then in the completion percentage of the project is very important. And your KPI, how your KPI should look like. So you should have the gross margin by job. Very important, so you can visualize it. And you should have your cost to complete, right? That percentage. So your cost to complete percentage, and then the variance of completion. Very important. Help you make smart decision. You are working strategic. You are doing everything with strategy. You know what is going on. You can visualize everything, and you have all this number tell you, all these metrics tell you where you are going, where you are. And I have a little example here, and we have 200K contract. We budgeted so this is an example if you are not doing a good job costing, right? So we have a 200K contract, and the budget cost is 160K. We stop there. You are not doing your job costing is not good. You stop there, right? And you assume that you have 20% gross margin. Okay, so you had 20% gross margin, and you are paying IRS that 20%. So if you take, so you have 40, you are claiming that you make 40K on this project. Is that true? No, it's not true, because you are missing two items, equipment and 12% of labor. And those two items cost you 18K. You declare that you have 40K. You are paying taxes on 40K. Do you really make 40K? No, you did not. You are missing the 80K here, right? So where this 80K is going, you don't know. So you are giving money to the IRS that they shouldn't entitle to. The age, normally, based on the example, your normal margin here is 9%. So you see, there is 11%, because your margin is 11%, because we have that 18K that we add up to the 160K. So that will give you a true cost of 178K. So your real margin here isn't 40K, right? It's 22K. So imagine if you have 5 projects like that you are not really account for those costs, the overall costs. How much are you going to pay out for taxes that you shouldn't? A lot of money, right? So we want to make sure that we have a good job costing in place. And then the third risk that we're going to talk about today is the mismatch billing versus vendor terms. So what is the risk? The risk here is that your supplier wants 30 days, but your customer, the owner of the project, want to pay you net 60 to 90 days, or only at the milestone, right? So you have a gap here. It's very expensive and stressful. You have a gap. So how are you going to pay your supplier in 30 days if you are getting money in 60 days or 90 days, right? So what is the strategy here? Okay, So the strategy here is that you want to make sure that you allow your billing with your vendor. What first? So make sure, so you want to make sure that every project you collected 10 to 30% deposit. So you want a deposit for 10 to 20, for 10 to 30% to start managing. And then you want to also, if there's a material that you have, that you pay for it and you store it, you also want to make sure that you build that. You can use that as a, you can use that as, you can use it to build your project owner, and you send them the proof of the invoice pay and the photo of the equipment that is in there, and you can switch from progress billing to tie to measurable milestone. Progress billing here, we bill at some percentage, right? But if you set to measurable milestone, so if you reach this milestone, if you reach this is how much I'm gonna charge you. This is I'm gonna pay you this. So that help you to have money more quicker than if you are waiting for a project to be completed before you get paid. And then all the other thing that you want to do is to impose the supplier terms. So you can request your supplier to be paid net 45 or 60. And then once you have paid on time, so that will help you to pay them when you get paid for the 90 days. And then also you want to use project specific credit line for everything related to the project. Do not use your operating cash to buy something that is project related. So everything that is project related should be buy through the credit line or on that specific project. You can also decide to take early discount, but only if your return in investment is more than 18% API equivalent. That means if your return in investment is less than this percentage, no, you should not take early pay discount. No, you should not take it. Okay. And the second thing is that you also want to have a cash calendar. So when you build a payment calendar that pay for each vendor, for each supplier, is very helpful for you. So that will take stress away from you. You are not getting surprising bill, right? So you know when you're gonna pay this supplier, you know how much you owe this supplier, when you are gonna pay it. And if your customer say, okay, they are paying you on the 25th of the month, you can schedule your AP on the 27th to the 30th of the month, only after confirmation of the funding. That remove a lot of stress on you if you have this in place. And for your API calculation for this particular one, you want to make sure that you want to know the day sale outstanding. So those calculations, you want to know those numbers. You want to know the day payable outstanding, and you want to know your cash conversion cycle. Those three numbers are very important for this particular risk, particular item. Those three numbers, you want to make sure that your KPI incorporate them. That will help you to visualize everything, to make sure that you are matching the billing versus the vendor term properly. And for this one, you need these three key metrics. Okay, the fourth one is the change order. The change order and cost overrun. So what is the risk here? So the risk here is that when you started your project, right? You want the project to keep running. And the cost that you did not account for pop up. You just want to, do it and move on, right? But before you do this, you want to make sure that this one, that the change order is pricey. How much this change order costs you? And you want to make sure that it's approved. And then you build them so you don't leave cash on the table. It wasn't included, so you should not be, so you should build them right away. No included, don't take that cost if you don't know how much and if it's not approved. You want to make sure that it's approved and you bill, then you move on. So don't work, like I said, no work without rating approval policy. No, and also you want to make sure that this job order have a description and the schedule of the impact. So everything should be listed. And you also want to make sure that you create a change order log for weekly review. I have listed something there here. I said you can have requested prices submitted, approved, bill, or pay. So that can help you. You can build a log like this to help you, for a better track of them and make sure that those change order were properly billed. So you can do this. And then for this particular item, you want to make sure that these 3 KPI, you want to make sure that this target, like I said, the change order approval lead time, the target should be less than 7 days, not equal 7 days and no more than 7 days, less than 7 days for proper cash management. The change order capture rate should be more than 100 or equal 100% monthly. And the code alert, the overrun code alert, for any code more than 5% over the budget have to have an explanation and a recurring plan for that. That have to have an explanation of why do we have this and how do we plan to recover it. If you do not have it, you have to implement that. Because these are the little things that make you spend money and you are not recovering them. So, and that will make you face some challenges, some chaos, some cash flow chaos in the future. Maybe in the near future, or I don't know. So you want to make sure that all of this that I'm telling you, you have it. So I have an example here on the P&L for the job costing for somebody that have a proper job costing in place. So for example, we have the project A, we have project B, we have project C, and if you see here the contract value, we have 60, 40, and 20, 600K, 400K, 200K. And you can see we have all the costs listed here. So the total cost, we have it here. We have the gross margin here for for project A, we had 205. For project B, we had 120, and for product C, we have 75. And we have also the gross margin per the gross margin percentage, and based on the gross margin percentage, you can see that we have a good we have this project, the project C is good. We have a good project margin there. So that is a project that giving us money, right? Giving us more money. We are not spending more on there, and we are gaining more. we know that the project B is the one that is, eating our profit, because it's eating our profit. If you can see, the project money is little lower. And then this is what we have, and the total profit margin is 33%. And then for this, at this stage, we have not allocated overhead costs. So our overall cost here is 120K. This project is one owner. So the administration expense is one owner. So the salary that you see here, you have the salary, the 120K include the owner salary, the rent, utilities, and little administration fees. So we have that here at 120. So we will allocate that. We have the allocation percentage, and based on the allocation percentage, we can see that the real net profit of each project we have. For this one, we have 145K, and for this one we have 80, and for this one you have 55. Like if you can see, we have the 55K. The 55K is good. So the project C is a good project. The cost is a little bit lower than the other one, and the one that is not, that the cost is higher, is the project B. Project B have a higher cost. So this is how you can, visualize it and make analysis and see, okay, if in the future I have a project, a similar project like project B, what do I do? So you know that the cost is a little higher, and you can know how to target more. You can increase the value on the project, because you already track those costs and see that will help you also decided for future project, similar future project. That will help you to budget better on those. And here we have an example of the retainage tracker. So I was saying that the retainage tracker should be by project and by customer. You can add here, I did not add the customer, but you can add the customer. So this is the 3 little project that I show you for this specific company. So you have the value here, you have the billing, what was billed to date, and you have the retainage percentage here, and this is the retainage percentage amount. And then the payment that we receive, we have billed them this much, and this is how much that company have billed them this much, and this is how much they receive. And for the retainage, this is how much they have that was released for the retainage. So out of the 50, they have received 20. Out of the 60, they have received 10. And this one, they haven't received anything yet. And this is the total balance of the retainage. So it's showing that, okay, those are the retainage balance that we have. We have to follow up, for that, to recover those money. If the project is completed, we have to follow up. If it's not, then we, at this stage of the project, how much we are going to receive for the retainage. That I was saying that is, so you want to make sure that you have 2% release on your retainage at 50% of the completion. Okay, this is all I wanted to share with you today. So you can see me here, and if you want to book the quick call with me, it's fine. Like our Nikki Moten, it was a good, I share everything that I had today regarding the cash flow risk, the cash flow risk management for construction businesses, for construction business owner. So you have everything there. If you want to implement it by yourself, it's good. Go ahead and implement it. If you want me to come to implement it, go ahead and book a call with me. I'll be happy to go over with you. Thank you for listening to me today, to join me today on this live, and let's meet again next week at the same time. Thank you.